Yo, what's up, everybody? It is Friday. Yeah, Friday, January 6th. Folks, I don't think I have to explain to you how manic and ridiculous the market can be when it is pushed around by participants who are engaged or believe in some kind of really psychotic single variable analysis. Like they have one thing that they look at, and that one thing, even that one thing, their understanding of that is wrong, or it's very unsophisticated, and everything they do is based upon that one variable. And of course, I'm talking about monetary policy, and I'm talking about the current environment of monetary policy, which is Fed rate hikes. Now, we had a good day today. As a matter of fact, the market broke, the S&P and the Dow broke above some very important resistance. So it was a good day. Dow was up 700 points, S&P was up almost 100 points. NASDAQ was up too. But what happened today? Before we even discuss what happened today, I think it's important to go back to yesterday. Yesterday, we had an ADP payroll report that came in a little bit hotter than expected. I think it was supposed to be like 150,000. It came in at what was like 235,000. And that triggered huge selling. I mean, at one point, the market was down over 400 points. We settled down to Dow, like down 340 points. And I even came on here and I said yesterday that, that was kind of a disappointing performance, because normally we see what we've seen as a trading pattern. And, very short term, I don't really like relying too much on these trading patterns, but I guess that's the floor trader left in me. Sometimes it can provide a tell. Sometimes it can provide an indication as to, the composition of the market. And by that, I mean, like, is the market short? Is the market long? So anyway, the pattern has been we get these daily sell-offs and then it rallies into the close. Yesterday, that didn't really happen. We settled down like 340 points in the Dow. So what happened today? Today, the government's job report came in at 223,000. I think that was the number. So it was a little bit less than expected. I think they were looking for something like 250. Basically, yesterday's number on the ADP, 235 compared to 223, basically talking about the same reading. But today, that was enough to drive the market up 700 points. So what was considered so terrible yesterday, today suddenly everybody's view of that reversed, and it reversed in a very big way. So again, I come back to this idea or this observation that if you are relying on some kind of single variable approach where you exclude every other component or element to the analytical outlook, okay, to the analysis. I mean, all you lean on is one single variable, and that single variable you have a very, I would say, a very weak understanding of its impact, its effect. And again, I'm talking about rates. People just don't understand that, there's going to be losers and there's going to be winners. And, your job is really to ascertain or to determine what areas of the economy or how the economy in total is affected. Because it doesn't matter if they're talking about rates. It doesn't matter if we're talking about inflation, about deflation, about trade policy. I mean, all these things have positive impacts and negative impacts across the spectrum. You just have to understand what they are. And this is not a hard thing to do. It's not a hard thing to do. I mean, look at the banks. I've been here pounding the table on the bank stocks. I mean, the banks are doing very, very well. JP Morgan is up something like 33 or 35% from the October lows. You know, the other major banks are up. Deutsche Bank, which was like a dog, people thought a couple of years ago, is that even going to survive? It's up almost 80% from the October lows. You know, I keep saying, like, the Fed is just handing out checks to the banks. And again, we come back to this idea, and I know some of you have raised objections to what I have said about, you know, this is a fiscal stimulus, and it is equivalent to the government sending out checks. And the main objection that many of you have, and I agree with it, by the way, is that number one, it's not all equally distributed, and number two, worse, it goes basically to people or institutions that already have money. And I totally agree with you. I mean, if we're going to argue about this or discuss this in terms of equality or inequality or inequity, I'm on your side, okay? But unfortunately, I'm not the one who designs and implements policy. I am simply an investor and an educator, you know, trying to help myself and to help you guys out. So I look at this through that lens, you know, as an investor. Look, if the system is rigged against me, in other words, you know, I'm not one of the elites, okay? I can't be in that very small group where everything flows to me and I'm outside the rules, basically. Then I want to do something to give myself at least some kind of advantage. That's why, you know, as I operate as an investor, I try to use whatever inequity in the system to enhance my position, okay? It's not like these big checks are flowing to me. You know, maybe I get some more money on my bank deposits. Maybe I have some government securities that I'm earning a little bit more, but I'm not Warren Buffett. I'm not JP Morgan. But, you know, I still use that information to my advantage. So, again, I always try to bring this back to the swimming pool analogy because I think that's the easiest analogy to understand when it applies to the you know, the macro picture of the economy. And I always try to keep you guys focused on the macro picture of the economy because, you know, like, yeah, you know, the rising tide floats all boats. You know, somebody asked me in a comment here, how come many stocks are still way down when the market averages are moving up? I mean, a rising tide floats all boats, but again, not equally. I mean, some of these boats, you know, they got big holes in them, okay? So it's going to take a lot of water, even if that, to ever float them. But I think a lot of stocks, particularly in the tech sector that have really been hammered down, they're going to come back. You know, it's a function of the economy. And, you know, will the economy stay in an expansion mode for a sufficient length of time to lift all, you know, to float all the boats? And yesterday I used the analogy of, you know, putting some big object in that swimming pool, that big object representing the psychology and the behavior of the monetarist zombies who want to sell, right? Yesterday I talked about how they've been telling us for months, like, hey, you got to be really afraid of Fed policy. But you also got to be really afraid of a recession. In other words, you got to be afraid of everything. And that's just not a rational position. That's again the single variable view. That's just seeing everything through, you know, like a microscope and not seeing really what the big picture is. But I could go on and on about this. The point I'm trying to make is that stay focused on that macro view. Consider at all times, you know, that swimming pool analogy. Is it getting filled up? And by the way, I provide in my report and my emails to my subscribers and the weekly report, MMT Trader, I mean, I give you actual numbers. I give you actual charts. It's not like you got to guess. And I have, by the way, I got my Understanding the Daily Treasury Statement course. That's $99. It's going to be the best 99. If you want to understand like these fiscal flows that I talk about, I mean, that's the best 99 bucks you're ever going to invest in your life. All right. If you go on my, and I think I have a link here, even in this, in the description box below, you can go there. I mean, at least learn. That's a free resource which comes out every single day, and that'll put you miles and miles ahead of the most, you know, what Wall Street considers, or who Wall Street considers to be the most savvy economists. I mean, they don't even look at this stuff. They're all looking at it the same way through the single variable approach, and they all don't understand it. They all don't understand it. And I'm not trying to say that I have some unique Einsteinian perspective on this. Like, I'm just looking at the numbers. Like, the numbers are very clear to me. Like, if the government is just transferring massive amounts of income into the economy, if the government is adding to those financial balances, if the swimming pool is coming, if the water level on the swimming pool is coming up, then I'm cool with that. Like, I'm bullish. Like, I've never said I was a genius. I just know that, you know, when the level rises, it's going to pick things up, and that's a position that you want to be bullish in. And again, if I saw that being drained like month after month, then there's no way we'd ever get a recovery in the stock market, and we would see unemployment at 10, 11, 12, 13%. But that is just not happening. Now, I'm not saying it can't happen. I mean, right now we're going through this shenanigans in the House of Representatives trying to elect McCarthy as Speaker. I think they're going on their 14th vote tonight. They adjourned until 10 p.m. and I think now he has the right votes. But the holdouts who have not, and I'm not pitching for McCarthy here, but this gang who has held out on, you know, voting for him, basically led by Matt Gaetz of Florida, they want like fiscal responsibility. And as McCarthy makes these concessions, like, I don't know what concessions he's making, but I'm assuming it has to go in this direction of fiscal responsibility. Now, luckily, we're good fiscally until September 30th, 2023. I mean, that's when this current spending bill, we'll have to get a new spending bill for the fiscal year 2024. But 2024, for all these economists who are predicting a recession in 2023, and I'm saying I'm not one of them, and you know I said there's not going to be a recession, but depending on what happens with this new Congress and, you know, the outlook for 2024 fiscal year, which starts on October 1st, but again, we got time, okay? We got time. I mean, they might very well trigger a recession in the fourth quarter of this year, or, you know, into next year, if they go with a spending freeze or worse, cuts. Okay, I think one of the proposals or concessions that McCarthy was agreeing to was a $75 billion cut in defense spending, which is like unbelievable, because, you know, that's the last thing that I would think that the Republicans would cut. Like I said on here many times, that defense spending is like an automatic appropriation, even though it's not. You know, it's discretionary, but it's treated in Congress like an automatic appropriation. So when the Republicans, of all people, are demanding a cut in defense spending, and I think that might be more or less tied to support for Ukraine. But let me just clarify something. Is a little bit like as a sidebar. All that money we you know, send to Ukraine, it's really spent here in the United States. It's spent to defense contractors, you know, military, stuff like that, armaments manufacturers, stuff like that. So it's not like necessarily it's going over there, but some, you know, we are crediting Ukrainian bank accounts for the continued operation of the Ukrainian government, or entire country, actually. But anyway, I just wanted to make that clear. So it's Friday, and yeah, get that understanding the Daily Treasury Statement. The link is in that course, so you'll enjoy that course, and it'll teach you a lot, and it's very, very helpful. Anyway, I'll see you probably on Monday. Bye.